Hello and welcome. My name is Josh, and this is Finance Soup. I wanted to take a couple minutes today to go over some common finance terms that you hear, and hopefully give you a better understanding of how businesses work, and some terms you might hear. I think finance tries to make things sound more complicated than they are, to scare people away and think, oh, only we can do what we do. But really, if you understand it and you break it down to the basics, it's much easier. I'm going to use a lemonade stand as an example, just because that's the go-to. And we're going to try and understand some of these terms that you might hear either me discuss or other people discuss online. So you start a lemonade stand. It's a business, but you start it with some friends. And so when you start it, you split ownership. It's not just you and your friend own the company together. So you each have shares in the company. Shares represent ownership in a company. So let's say you each say, hey, let's break it down to 10 shares. So you break it into 10 pieces. You get 5 shares and I get 5 shares. So you each have half of the company. So share count is the number of units a company is divided into. When you go on a ticker like Apple, you'll see a share price. That's up here. You'll see the market cap. It's worth 2.5 trillion-ish. The price actually doesn't matter. Really, what the price is, it's the total market cap, which is what the company's worth, divided by the number of shares. So if Apple had 10 shares, each share would be worth $250 billion. Obviously, there's a lot more than that. Millions of shares. Actually, let's look it up. APL shares outstanding. So they have 16.5 billion shares. So there's 16.5 billion little slices of Apple. So each one you own is a little piece of Apple. So that's what you do when you own a share. So again, talking about the lemonade stand, this is if it was publicly traded, what would be the price of 1 unit of ownership? One of those 10 slices in the lemonade stand example. Market cap. So market cap is the number of shares outstanding, how many shares there are, so 10 in this case, times the price. Let's say the price at the time is worth $1 each, then the market cap of your company is $10. If the price went up to $2, the company would be worth $20, right? 10 shares times the price. So that's how you value the business on the stock exchange. So again, if you took this number in Apple, $16.5 billion times 150 bucks, you get 2.46 trillion ish. Let's go back to these examples. So enterprise value. So this is a more finance technical way of looking at a business, but it is more accurate. So sometimes you'll see this as EV. It stands for enterprise value. So it's the actual value of the business itself, not the company, but the business. So again, let's say you start a lemonade stand and you borrow $10 to start the business. So again, your market cap's $10, but you had to borrow money to buy some stuff. So you take the market cap, which is $10, you take the cash you have minus the cash. So again, you have $10. So what's the business actually worth? It's worth 0 because you have $10, which you used to start the business. So even though the company's worth $10 on market cap, it's 100% cash. So the business itself is worth 0 because you haven't produced anything yet. It's just a pile of cash. So that's why you subtract cash and you add in debt, because really you're trying to look at what is the business itself worth, not how much is the cash you have worth. Again, if you had a business that had $1 billion and that was it, it'd be worth $1 billion because it's worth $1 billion, the market cap, but the business would be worth 0. Obviously, if you produce something of value, then the value has something. So for example, Apple, and most companies do have their enterprise value close to their market cap because most businesses that you'll see on the stock market are money-making businesses that actually have businesses. So if we look here, we can see Apple, again, it's worth 2.5 trillion. Let's look at Apple enterprise value. It is worth 2.45 trillion, which is, again, almost the same as its market cap, 2.46. Again, typically these will be very close, but sometimes with businesses that have tons of cash or tons of debt, or very early businesses that aren't revenue generating yet, you will see this number be very different. So that's what enterprise value is. Okay, revenue. What's revenue? Well, when you sell lemonade to someone, you sell lemonade for $1, a glass to someone, that's revenue, what you brought in. So the dollar per cup that you're making is revenue. So that's the money you bring into the business. Cost of goods sold. So that's the input costs to make that glass of lemonade. So, probably you needed water, you needed lemons, and you needed sugar. So how much did that cost? So let's say on that glass you spent 25 cents worth of lemons, sugar, and water. So that's when you subtract out the cost of those goods from the revenue, you get gross profit. So that's 75 cents. Again, it cost you 25 cents for the water, sugar, and lemon. You sold it for $1. The remaining is gross profit, 75 cents. You can also see this as what's called a gross profit margin. So what percentage of your revenue is gross profit? So that'd be 75% here, right? Operating expenses. So that's what it takes, the cost to run the business. Well, you needed to, maybe you hire someone, maybe you needed to put up flyers all over your town. So you had to go spend money on marketing. That's a common expense. Maybe you needed to buy a recipe book to find what the best one is. That's research and development, right? These are costs to operate the business. Maybe you actually had to buy a stand or some equipment, a jug to pour it out, and some cups. These aren't the input costs, but these are operating costs. So you need so plant, property, and equipment's a common one, or so like stuff like rent. It's not the actual long-term equipment, short-term stuff. So cups, sales and marketing, and research and development. Those are the three most common operating expenses. And when you subtract out the operating expenses from the gross profit, you get operating profit. So that's the amount you made after subtracting the cost to operate the business. So again, let's say it cost you per glass, let's say you spent 50 cents on a recipe online, and that was your only expense, then you'd have 25 cents left over from that glass of lemonade, right? So you brought in $1, cost you 25 cents to make it, cost you 50 cents in operating expenses, you got 25 cents left over. The government wants their piece, so you got to pay your taxes, and then you get net profit. So net profit's after taxes. So maybe you're left with 15 cents of profit at the end of the day. So what's cash flow? Cash flow is the profits that come into a business, the cash that actually comes into a business. Let's say someone says, hey, I'd love for you to sell me lemonade. We have a baseball team and we're always parched. I want you to give us lemonade every Sunday, which is when we play baseball. I'm going to give you money up front. We want 500 glasses of lemonade over the year. But I want a discount because I'm paying you all now. So instead of $500 for like $1 a glass, I'm going to pay you $400 for those 500 glasses. So he pays now. So that's cash that came in. You just brought in $400. Big moves with this lemonade stand. But you can't book that as revenue, according to accounting, until you actually sell the goods. So every week, when you're giving out some of that lemonade, you can book more of that as revenue. So that's the difference between cash flow and profits. So you can bring in cash now to help your business, but you can't book it as a profit until you actually sell the good. That's an example. There's lots of examples. Tesla, I put down $100 to reserve a Cybertruck. Again, they bring that money in, but they can't book it as revenue until they sell me a Cybertruck. So that's what cash flow is. Capital expenditures. I misspoke earlier when I said plant, property, and equipment. Capital expenditures, or sometimes we see it as CapEx, is long-term investments into plant, property, and equipment. So that's like, again, if you needed to buy a spot, or he's like, oh, I'm going to rent a little lemonade stand, or I'm going to rent not rent a place. I'm going to buy a piece of property so I can put my lemonade stand and build a lemonade stand, something that's long-term. Then that goes in capital expenditures. So that's not operating expenses, which are short-term expenses. Those are yearly expenses. These are long-term. So again, I'm buying a building. I'm buying a juicer, a commercial juicer that's going to last me 20 years. Something like that. That is capital expenditures. Something like cups that you go through every day and, that are part of the everyday operating expense of the business are operating expenses. Long-term expenses are capital expenditures. Again, plant, property, and equipment. And the last one, this is going to be the most complex one, but it's called EBITDA. You might see this a lot. It stands for earnings before taxes, depreciation, and amortization. So again, we got earnings, which is another word for profit, before taxes. So we want to ignore taxes. So then we got two other words that maybe you're not familiar with, maybe are depreciation and amortization. So what is depreciation and amortization? They're, again, accounting terms for how you finance different expenses. So again, we bought a juicer, chemical juicer. It's worth $100. Let's say we bought it for. So that's a capital expenditure, but it's not going to last forever, right? Let's say we think it's going to last 10 years. So rather than having it on your balance sheet, then you have assets and liabilities. Right now, it's an asset of $100, but in 10 years' time, it's going to be worth $0. So rather than going, okay, now it's $100, $100, $100, and then one day it's just worth $0, instead what they do is they depreciate it. So they say, okay, it's worth $100 now, it's going to last 10 years. What's 100 divided by 10? $10. So every year we say it's worth $10 less. So first year it's worth $100 as an asset on my books. The second year, it's only worth $90, then $80, yada, 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 until it's worth $0. So that's depreciating. You are depreciating the asset's value. And unfortunately, that comes off against your profits. It's not a cash expense. Again, you didn't have to pay $10 extra for it, but it is an accounting way of understanding why something's worth less. Amortization's a similar concept of how do you amortize your mortgage over a longer period of time. It's about how you're paying off things. Again, it's a non-cash expense, but it is an expense because there is wear and tear on equipment that does take time. And there are financing costs and stuff like that. So these are all non-cash expense. So that's why EBITDA is often a proxy for cash flow. It's not exactly cash flow, but it's a good understanding. So you might see people value a company based on EV, enterprise value, to EBITDA. So again, you're trying to understand what is the company worth per cash flow proxy. So how much the company brings in, ignoring depreciation and amortization, because those are non-cash expenses. So again, hopefully that lemonade example made it a little more simple, and you can understand how to value some common terms you might hear with businesses. So revenue, how much you bring in; gross profit, how much you bring in after accounting for the input costs. So again, the lemon and the sugar there. Operating expenses, how much it costs to run the business. Operating profit, how much you make after spending all that. Capital expenditures, long-term investments into things. And then, yeah, hopefully that made some sense. And again, my name's been Josh Lipton, and thanks for listening.